Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, February 13th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will U.S. dollar strength die at a potential Mar-a-Lago Accord? Ooh, this is getting spicy. So our answers are perhaps. If so, that outcome represents significant upside risk for risk assets. Moreover, global risk assets are likely to continue outperforming. One dynamic that has provided relief to broadly undervalued international equities this year has been the U.S. dollar's surprising lack of resilience amid fresh evidence of our resilient U.S. economy and sticky inflation themes, contributing to a further hawkish repricing of U.S. dollar money market curves. The U.S. dollar index is down 1% despite those supportive dynamics and the threat of fresh tariffs, which have historically perpetuated U.S. dollar strength. Gold has absolutely loved the reprieve in the U.S. dollar, rallying 11% year to date as February 13th and outpacing the 3% year to date return of Bitcoin. Our KISS and Dr. Mo signals remain max long of both assets. All told, there is an undeniable broad-based down dollar trade going on that is being funded by rotational flows from U.S. stocks in the crypto market. Could President Trump be using his chaotic tariff threats as leverage to force key trading partners, economic rivals alike, to negotiate his version of the Plaza Accord? We cannot rule out a globally coordinated decline in the U.S. dollar, given President Trump's desire to eliminate U.S. trade imbalances by reshoring manufacturing and eliminating U.S. reliance on foreign adversaries for strategically important goods. Global equities and precious metals suggest you should add a potential Mar-a-Lago Accord to your 2025 bingo card. Listen to the market. Transitioning, as always, to our 42 Macro client dashboard here is always a wrap up with a question from our client community. This one's a little long one today, but I thought it'd be fun, certainly a little bit more fun to talk out loud as opposed to replying in text. So let's just read it out. It says, can we control spending and grow out of the death spiral? Can we keep the ship off the reef if Besson's three threes, which is 3% deficit, 3% GDP, and $3 million barrel per day boost in domestic oil production? Of course, keeping inflation in check will be key. If we accept Steve Hankey's quantity of money theory, then it seems more achievable. We have to control spending and grow the economy and in return taxes to get there. Cutting taxes can stimulate the economy, allocating capital more efficiently and increase money velocity, per super optimistic Art Laffer. I disagree that this person disagrees that cutting the third rail is off the table, and they go on to cite examples with defense and Medicare on how we can potentially get spending under control with some relatively common sense policies. Summarizing, it says cutting defense and cleaning up food and drugs has long been a just cause of progressives. The fact that Democrats and most Republicans are against it says a lot about our political anatomy. I think the labels left and right, Democrat and Republican, have lost much of their explanatory power. If you told someone 12 years ago that we would elect a president who put RFK and Tulsi in their cabinet, with Elon joining in the Doge department, they would have thought we elected a Democrat. In fact, they were all Democrats, including Trump, until recently. This person believes a more probative framing is two parties, one DC entrenched and independent, currently led by MAGA with very reluctant Republicans that are there just to stay in power. So obviously really thoughtful, kind of a discourse there. And then, by the way, this is the kind of thoughtful discourse we get from our community of clients, in our community chat. We don't have the, no offense to the crypto community, but we don't have a bunch of 20-year-old horny Elon Musk, fanboys, yelling at each other on Twitter and calling each other names, or people who don't agree with their names. This is a community full of thousands of thoughtful investors, many of whom are professional investors, some of whom are some of the most important PMs and CIOs on global Wall Street, interacting with each other on the basis of thoughtfulness and sharing of ideas, and ultimately trying to get to the right answers from a portfolio construction and asset allocation perspective faster than anyone who's not in this community. So super appreciative of this. I really do think of all the things that I've been part of building in my entire life, this is the most important thing that I've ever contributed to. So super grateful for this. Super grateful for the growth that we continue to see The community chat is booming. There's a lot of really awesome interactions and thoughtful discussions just like this, with not just me chiming in. Obviously, I'm chiming in too, but I'm just one of thousands of voices in this community of really thoughtful investors who want to interact with each other on the basis of respect and thoughtfulness, as opposed to a lot of stuff that we tend to see on social media. So getting back into the question, yeah, I think there's a very clear path to stabilizing the debt, whatever the heck that means. I prefer to see the debt to GDP ratio going down, but we know we're not going to have achieve budget surpluses or a persistently positive spread between GDP growth and deficits, the size of the budget deficit as a share of GDP to achieve that. So in the absence of that, just stabilizing the debt to GDP ratio by having the deficit and GDP growth compound at the same rate, that would be ideal. Who's to say that it's possible? But clearly, that's the goal. If you listen to Scott Bessent, who basically everybody in the investment community assumes is running policy. If you're not in the investment community, if you're some person in middle America, you think President Trump is actually in charge, and obviously he is. So I want to make sure that us Wall Street types don't get carried away with us, envisioning the policies that we want, as opposed to over envisioning the policies that are most likely. But getting back into this, yeah, if you did some version of that, you could have a positive supply shock in the economy, and this is something we've been talking about for months with respect to our triple S's theme, right? If you think about the 5 major policy platforms that President Trump has outlined, both on the campaign trail and also since he's been in power, 2 of them are bad and are likely to result in negative supply shocks for the economy and asset markets. That's tariffs and securing the border, which will basically end this very positive labor supply shock that that we had. And all the goodies that came along with that in terms of above trend disinflationary growth, persistent above trend corporate profit growth, persistent double digit type returns in the stock market, or 20% plus annual returns in the stock market. I mean, that positive labor supply shock, as bad as it was for human beings in this country, it was really positive for corporations in this country. And obviously, when we invest in the stock market, we're not investing in pissed off people in middle America. We're investing in U.S. corporations. So be aware of that. And when I say middle America, I mean just the middle of the country, not the pejorative way, just the physical middle of the country in Midwest. So getting back into this, could we are these things like defense and Medicare and whatnot third rails? They've been identified as third rails as the people in charge, namely President Trump and Republican John Thune, Mike Johnson has alluded to this. So we know that Medicare has been ring fenced. We know Social Security is going to be ring fenced. In our opinion, obviously they can't touch national debt, and we know that's going to go up by another $100+ billion this year, just as a function of the refinancing into a higher interest rate regime. And in our view, we think national defense is going to go up, not down. Just given the all the expansion manifest destiny across both North America, Greenland, and ultimately this concept of setting up regional economic and defense zones that President Trump has floated out. I don't think national defense is going to go down in that situation. It's probably going to go up, but I could be wrong on that. But if you assume that it's going to be flat, the 4 categories I just outlined, Medicare, Social Security, national defense, and net interest, have been growing at a compound 15% annual rate over the past 3 years. That's 65% of the federal budget, compounding at plus 65 or 15% on a trailing 3-year CAGR basis. Now, we know Social Security, Medicare are probably going to continue to go higher as a function of our demographics in terms of our old age dependency ratio accelerating about 800 to 1,000 basis points over the next 10 years. We know net interest is going to continue to rise as our debt rises and as we continue to refinance lower interest rate expiring lower interest rate securities with higher market-based interest rate securities. And we can have a thoughtful discussion around where net national defense is going, but we're in a fourth turning, and fourth turning is where total war tends to happen. So I'm not forecasting total war, but I will tell you that assuming national defense is going to go down as we crescendo into the climax phase of this fourth turning seems to be a very very low probability event, in my opinion. So we know 2/3 of the federal budget is compounding at plus 15% for structural and demographic reasons and just market reasons that we can't control. So you have to cut the other third, essentially 35% of the federal budget, by more than that just to stabilize spending just to stabilize it. And so when we go back to this Doge process, which, obviously I've been very supportive of, and, I think I kickstarted the conversation around the U.S. Fiscal crisis risk last fall that kind of led to this whole Doge process. I think our friend Elon probably saw some of my tweets last fall before he got involved. But anyway, in my opinion, I think where we're headed with this is, I think the end result of this is we're going to be disappointed with the amount of deficit reduction that is achieved. Now, Doge may have a significant, expenditure reduction. We're talking $500 billion to $1 trillion of expenditures that we're forecasting which represents a significant amount. But if you offset that with further tax cuts, we believe in the Laffer curve, but who's to say where we are in that Laffer curve? What we did last time with tax cuts actually contributed to faster debt growth. So in my opinion, we're probably too far to the, we're not where we need to be on the Laffer curve to expect tax cuts to contribute to lower deficits. We're probably still where we are, where tax cuts are contributing to higher deficits, in my opinion, just based on the most recent example of the Trump tax cuts. You're probably going to wind up with the same or slightly lower deficits that we currently have. And right now we're tracking at minus 7% of nominal GDP in a fully employed economy. Maybe we get that down to 5. I don't see how we get it down to Scott Bessent's 3. And so ultimately, this process could wind up being disappointing on a net basis when it's all said and done. But again, I think it'll be a year, perhaps more than a year, before we get a real true sense of how President Trump's 5 policy platforms are going to net out. You got, again, we talked about the negative supply shocks from tariffs and securing the border. On the positive side, we got tax cuts, deregulation, and Doge cuts, which, are all positive supply shocks. Tax cuts, positive supply shock to, capital as our Doge cuts. Deregulation, positive supply shock to goods and services in the economy. So, there's a path forward here that is positive, and it's probably going to be a net positive, in my opinion, just based on our previous experience with the previous Trump administration. That was pretty good economically. It's a booming economy, booming markets for the most part. But ultimately, if we're hinging on, what is currently happening in D.C., saving the bond market, according to Scott Bessent, maybe we have a rally in bonds, as we hear more about Doge. But I think maybe a year from now, bond yields are probably higher, because at the end of the day, if you go from 7% nominal GDP deficits to 5% nominal GDP deficits, that's probably disappointing in the context of term premium being well shy of their historical means. So I rambled on for too long. This is probably a better conversation over some beers. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, February 13th, 2025. Best of luck out there today. We'll catch you back tomorrow. Cheers.